Machine learning is transforming industries, detecting cancer, driving cars, decoding language. But when it comes to investment management, something doesn't add up. Why do so many ML strategies fall apart when money is on the line? Why do backtests sparkle, only for live results to collapse? And why do academic discoveries so often turn into portfolio disasters? This video pulls back the curtain. We'll explore why machine learning struggles in finance, from limited data and false positives to backtest overfitting, the winner's curse, and the hidden dangers of sloppy research. Whether you're an investor, quant, researcher, or simply curious about the intersection of AI and markets, this is the hard truth behind the hype. Watch to the end, because what you don't know could cost you. Machine learning has made huge advances in fields like medicine, physics, and consumer tech, and a big reason why is data. These fields have massive, rich data sets to train on. But in finance, that's just not the case. Most investment strategies, especially those with longer time horizons, rely on monthly or quarterly data. That means even over 50 years, we're working with maybe 600 to 700 data points. That's not enough to feed data-hungry models. It limits our ability to validate results, test stability, or avoid overfitting. In short, the very things that make ML powerful don't work as well here. And there's another complication. Financial markets don't follow fixed laws like gravity or thermodynamics. Instead, they're shaped by human behavior, shifting incentives, emotional reactions, and even by the research that's already been done about them. This creates unstable relationships. Patterns come and go. As soon as a strategy gets discovered and published, it can quickly stop working because others rush in to exploit it. And if your instinct is to just add more features or variables, be careful. That's the curse of dimensionality. The more inputs you add, the more data you need. But the historical record is finite. You can't manufacture more time. In finance, data is limited, relationships change, and the rules are never static. That makes it one of the hardest testing grounds for machine learning. Think the biggest danger is bad data? Think again. Up next, how our very methods of searching for patterns might be setting us up for failure. In empirical finance, the term data mining isn't a compliment. It's a warning. It suggests you're finding patterns in the data that aren't real, that only exist because you looked long enough or tried enough combinations. And the problem is getting worse. Not long ago, data was expensive. Computing power was limited. That forced researchers to stay grounded. They had to start with hypotheses that made economic sense, not just statistical flukes. But today, the game has changed. Anyone with a laptop can access terabytes of financial data. An iPhone X has more computing power than a 1980s supercomputer. Cloud services and open-source libraries have made large-scale analysis nearly frictionless. That sounds like progress, and in some ways, it is. But it also opens the door to brute force searching, testing thousands of models, combinations, and tweaks, without ever asking if there's a sound economic reason behind the results. The danger? You find something that looks like alpha, but it's really just noise, a coincidence, a mirage created by overfitting. So, we've exposed the minefield. But what happens when these shaky strategies hit the real world? Let's talk about backtest overfitting, and why it's one of the biggest traps in quantitative finance. All right, let's take a quick pause. If you're finding this valuable so far, if it's challenging the way you think about machine learning and finance, now's the perfect moment to like, share, and subscribe. It really helps support the channel and keeps this kind of content coming. Backtest overfitting. It's the classic trap in quantitative finance. A strategy looks brilliant on paper, passes all the historical tests, and then collapses in the real world. Why? Because those backtest results aren't always what they seem. Researchers, even with the best intentions, are often under pressure to deliver something that beats the market. And that pressure can lead to subtle forms of data massaging. Maybe you shift the start date, maybe you exclude the 2008 crash, maybe you drop a few outliers that don't fit the story. Suddenly, your model looks like a winner. But it's not real. It's been engineered to fit the past, not to predict the future. And with today's computational power, you can run thousands, even millions, of variations. That means the odds of finding a strategy that looks good purely by chance go way up. Even tools like cross-validation, which are meant to guard against overfitting, can fall short, especially in finance, where the data set is limited and noisy. So, a backtest might impress. It might even get published. But once it's deployed in the real world, it can fall apart, fast. And even if a strategy makes it to publication, does that mean it actually works? Let's unravel the winner's curse. In quantitative finance, the winner's curse has nothing to do with bidding wars, but everything to do with overfitting and false confidence. It describes a recurring pattern. A model performs incredibly well in backtests, gets published, and then falls flat in live trading. Why does this happen? Because what looks like a brilliant discovery is often just a selection bias in disguise. Researchers test thousands of models. Most fail, but the one that shows the strongest results, the winner, gets all the attention. And yet, that performance, it's often just luck. A random spike in historical data that doesn't repeat out of sample. Academic studies confirm this. Many published factors see sharp declines in performance after they're released. Some disappear entirely. The supposed edge was either exaggerated or simply never real. And here's the deeper problem. The research ecosystem rewards results, not robustness. If a strategy looks great in backtests, it gets the spotlight, whether or not it's actually reliable. The result? A flood of false positives and an illusion of predictive power. But it gets worse. What if the entire story behind the strategy was made up after it worked? Next, why an ex-ante foundation isn't optional. It's your only defense against fooling yourself. Here's why ex-ante logic, having a clear economic rationale before you run your models, matters now more than ever. In finance, starting with a sound hypothesis isn't just good practice. It's a defense against deception, especially self-deception. An ex-ante foundation brings discipline. It forces you to ask, does this make economic sense? And that reduces the risk of overfitting. Without that anchor, machine learning models can easily find patterns that look impressive, but are pure coincidence, with zero causal link to future returns. And what happens then? You end up creating a story after the fact, an ex-post narrative, to explain what the data just happened to produce. But here's the catch. If the algorithm had found the opposite result, you'd probably have come up with an equally convincing story to justify that too. In other fields, like medicine, you can explore data first and then test the findings in large, fresh, out-of-sample trials. But in finance, we don't get clean new data. History doesn't reset. So if you're just chasing patterns and stitching together explanations after the fact, you're building castles on sand. And in live trading, those castles can collapse, along with client capital. And even if you believe your model, your stats might be lying to you. Let's decode the parallel universe problem. You've probably heard the phrase statistically significant, maybe a result that exceeds a 2 sigma threshold. Sounds impressive, right? Well, not so fast. Multiple testing and the so-called parallel universe problem show just how easily those significant results can be nothing more than statistical noise. Here's the issue. When researchers test dozens, or even thousands, of models, some are bound to look good purely by chance. If you run 20 uncorrelated strategies, odds are at least one will hit the 2 sigma mark just by luck. That means the true threshold for significance should be much higher when multiple tests are involved. But in practice, that adjustment is often ignored, and it gets sneakier. Even if someone reports just one test, chances are that model wasn't chosen in a vacuum. It was picked based on prior tests, previous tweaks, implicit filters, or what we might call parallel universes of analysis. So, what looks like a strong result might actually be just the best outcome from a giant haystack of alternatives, most of which failed and were quietly discarded. The danger? These false positives inflate confidence in models that aren't truly robust, and they often fail the moment they go live. Okay, stats aside, what about the real-world costs? Let's talk about trading fees, data quality, and the hidden risks that can kill even the best backtest. All right, let's take a quick pause. If you're finding this valuable so far, if it's challenging the way you think about machine learning and finance, now's the perfect moment to like, share, and subscribe. It really helps support the channel and keeps this kind of content coming. Here's how trading fees and dirty data can quietly kill even the most impressive models. In academic finance, trading costs are often ignored, but in real markets, they matter a lot. Even modest transaction costs can wipe out the thin edge of a strategy that looked profitable in backtests. What seemed statistically significant? Gone. One critical measure is implementation shortfall, all the costs incurred between your model saying buy and the trade actually getting executed. If you overlook that, your backtest isn't just optimistic, it's misleading. But it's not just the cost of trading, it's the quality of your data. If you feed a machine learning algorithm flawed, inconsistent, or outdated data, it'll still find patterns, but there'll be patterns in the noise. Garbage in, garbage out. It applies more here than anywhere else. And then there's the hidden risk in how we handle the data. Transformations like scaling or Windsorization. These can subtly shape the results. If your model only works after cutting out outliers, without a strong economic reason, you're not fixing a problem, you're fitting a fantasy. Each of these choices, transformations, exclusions, filters, they act like silent variables. Unless you define them ex ante, you're just adding more ways to overfit. So how do we fix this broken process? Enter the 7-point protocol, your checklist for doing it right. So how do we bring rigor back into quantitative research? How do we separate real signals from illusions? Enter the 7-point protocol for research in quantitative finance, a comprehensive framework designed to minimize errors, reduce false discoveries, and make investment strategies more robust in the real world. This protocol isn't just for traditional statistics, it applies equally to machine learning. Its goal is simple but ambitious. Maximize the discovery of true strategies while minimizing the risk of fooling ourselves. Here's what it demands. First, start with an ex ante economic hypothesis. If your model doesn't have a solid reason to exist before the data is touched, it's not research, it's just storytelling. Second, track all models and variables tested. Every tweak counts. Ignoring the multiple testing problem means ignoring reality. Third, define your test samples up front. Clean your data carefully. Document every transformation. And don't cherry-pick outliers or Windsorize your way to a better Sharpe ratio. Fourth, remember, real out-of-sample testing only happens in live trading, so stop modifying models based on pseudo-out-of-sample performance. Include realistic costs and data revisions in every test. Fifth, respect the market's dynamics. Things change. Factor crowding, regime shifts, and structural breaks can turn a great model into dead weight. Don't tweak live models to chase performance. Sixth, fight the curse of dimensionality. Simpler models are more robust, and when possible, use interpretable machine learning, not just opaque black boxes. Seventh, build a research culture that values science, not just sexy backtests. Set the expectation that most experiments will fail. That's how science works. And in finance, that humility can protect your client's capital. The 7-point protocol is not a silver bullet, but it's the best defense we have against self-deception. In a world full of noise, it brings discipline. In a field full of false hope, it brings clarity. And in the hands of a responsible researcher, It can help deliver what truly matters, better outcomes for investors. Machine learning in finance is full of seductive illusions, backtests that dazzle, correlations that disappear, and models that collapse under the weight of reality. But now, you're better equipped. You've seen why financial data is different, how overfitting creeps in, and why a solid research protocol is not a luxury. It's a necessity. If this video gave you new insight into the real challenges of quantitative investing, please like, subscribe to the channel, and share it with someone who values evidence-based thinking over hype. And if you're serious about bridging the gap between machine learning and real-world portfolio management, stick around. More in-depth videos are on the way.